please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
But anyway, let's move on and invite our next guest. Now, this morning, of course, the market reacted rather negatively to what came over the weekend. Perhaps the market thought the moves were a bit underwhelming. Rahul Chadha, Chief Investment Officer at Mirae Asset Global Investment, now joins us on the line. Rahul, hi, good afternoon. So, as a foreign investor, your thoughts on the kind of rupee move that we have seen over the last fortnight and also the market move. Your first thoughts.
Okay. Now, clearly, rupee was the single biggest concern which foreign investors have. Look, we all knew about India's trade deficit, the current account deficit, which was hitting about 2%. I think where the currency gets all the more vulnerable is in this escalation of trade war between China and US, where we've seen renminbi slip, where we've seen the rest of the current account deficit economies see the currency slip. So what you wanted from government was something which was kind of a more concrete. This measure works well in normal time, but I think what the market today needs is a reserve accretion of $30–40 billion. Market needs is a kind of a comfort that central bank has these $30–40 billion to defend the currency. Else, the currency is being like a stock where the levels are being tested every now and then.
Rahul, the question is, where will the $30–40 billion come in from? I mean, the DEA secretary told us that the government's back-of-the-envelope calculations are about $8–10 billion with whatever was announced over the weekend. But do you really think that kind of an inflow is going to be required to stem this rout? Can the rupee weaken even from where we are?
Yeah, I think it's more an issue of confidence building. Basically, if you look at what is the event calendar over the next 6 months, you've got highly likely this escalation of trade war between US and China, where US may impose tariffs on another $200 billion of imports from China, which means renminbi slip. And historically, we've seen rupee slip with renminbi. We've got sanctions on Iran coming around November 9th, so that can lead to a flare-up in crude. And then we've got election uncertainty. So we've got 6 months of uncertainty here ahead of us. And now, logically, nobody expects rupee to be kind of a stabilizer of 72. But if we want it to be stable around 74, 75, people need to have the comfort that, look, RBI has got enough to defend the currency, to give exit to anybody who may press distressed sales, whether it's in bond, equities, etc.
Okay. That is interesting because in that case, how should portfolios be positioned? So far, people were hiding in the HDFC twins, the Bajaj Finance, consumption stocks. But the last 1 month, we have seen most of these stocks have also declined about 10–15%, Rahul.
Yeah. See, I think over the next 6–9 months, exporters would do well. The paradoxical point this time around is, unlike 5 to 6 years back when we had IT sector, which was growing much faster, 15–20%, growth rates today are a lot more moderate, 7–8%. In the past, we had pharma doing exceptionally well. This time around, there's an issue with most of the companies in the sector. So obviously, there is a problem all fund managers are grappling with, that, look, where do you park your funds? And some of the domestic demand names which are trading 1–2 standard deviation over their 5-year mean should correct. A lot of these names were trading on the premise that, look, growth is going to be stronger for longer. And I think that premise gets challenged in the next couple of months of macro vulnerability.
Rahul, so far this year, the MSCI India index is down about 8–9%. The MSCI Emerging Market Index is down much more. I mean, I think 17–18%. Is there a risk that that gap is going to close on the downside? Basically, is there a risk that we could be looking at a much bigger equity market correction? We're only off 3% from the top here in India.
Okay. So if you look at what's done well in markets from May onwards, it's been consumer staples, it's been exporters, Reliance, IT, etc., power. I think some of these exporters may hold on to their gains, but consumer staples, which are trading at whatever 45–50 times 18 months forward, they're likely to go back to the normal valuation of 30–35 times. Or these NBFCs, which are trading at 30 times 18 months forward, they'll go back to more sensible valuations of 15–20 times. So you'll see a valuation correction because, look, right now what was happening was whatever growth numbers one saw over last 3–4 quarters were extrapolated forever. I think that's where market gets kind of a rude wake-up call, basically.
Okay, the market's making a bit of a move once again back towards the low point of the day. Don't lose sight of that. Sensex is down 500 points now. The Nifty down 140, the Bank Nifty 360, and that mid-cap recovery is also getting sold into. So just would want to keep an eye on that. Rahul, you said exporters will do well. but they have done remarkably well. And this rally started actually not just this year, it started somewhere at the perhaps second quarter of last year. So we've had 1.5 years of very solid run in IT stocks. Agreed, Rupee is a tailwind, but from valuation point of view, is there still more room?
Okay, so what would happen is these guys would do well on a relative term, probably up 4-5%, whereas rest of the names we were discussing will be down 10-15%, and that's where the alpha would be generated. But look, if you look at some of these stocks, you're absolutely right that we've reached the top end of valuation, and upside may be only 5-10% from here.
Rahul, given what you said, I can't help but feel a little nervous. Because, I mean, NBFCs, the big marquee NBFCs, the big banks and consumer, they've been the pillars of this bull market here in India. And if you're saying there's a 10-15% correction coming in some of these stocks, then we're looking for a pretty steep index level correction as well, right?
Yeah, but then look, in a healthy economy, you can get these corrections here and there. So I think you'll get some pullbacks, but those pullbacks are good entry points for medium to long-term investors. And somewhere with these pullbacks, you will have some of the election uncertainty also kind of a priced in. So I get what you're saying, but look, if having seen these names go up 50-60% over the last 3-4 years, one should be willing to take a 10-15% pullback in its stride there.